For the last 12 years, my bills were paid entirely by dividends. No boss, no 9 to 5, and no selling off my shares to survive. It sounds like the ultimate financial dream, right? But if I could go back to day one and talk to my younger self, I'd tell that guy to stop celebrating so early. Dividend investing sounds like passive income heaven until the reality of a global market shift hits your bank account at 3 a.m. Today, I'm pulling back the curtain on what it's actually like to live off your portfolio for over a decade. I'm going to challenge the common beliefs you see all over financial social media and expose the mistakes that almost cost me everything. By the end of this, you'll know the 3 brutal truths that most dividend influencers are too afraid to tell you. I started this journey back in 2012 with a relatively modest sum and a very aggressive savings rate. Over the years, I systematically built a portfolio that eventually generated enough cash flow to cover my rent, my food, and my travel. At its peak, this portfolio was producing a consistent 5-figure annual income, allowing me to quit my traditional job and lean entirely into the dividend investing lifestyle. It felt like I had cracked the code to financial freedom. I was the guy getting paid while I slept, watching the notifications hit my phone every time a blue chip company distributed its earnings. But behind those screenshots of dividend payments was a series of problems no one talks about. The numbers on the screen looked great, but the stress behind the scenes was something I wasn't prepared for. We've all seen the narrative. The dream of dividend investing is sold as a perfect, indestructible machine. You buy a few shares of a famous beverage company or a massive tech giant, and they send you a check every quarter for the rest of your life. The popular advice suggests you should never sell your shares, only live off the yield and watch your wealth grow indefinitely. It's presented as the most honest way to invest because you're receiving actual cash rather than just paper gains. People love the idea of an automated lifestyle where the work is done once and the rewards last forever. I believed that narrative. I leaned into it hard. But after doing this for 12 years, I discovered something most dividend channels never mention. And it starts with the biggest lie of all, the idea that this is truly passive income. Brutal truth number 1 is that dividends are not truly passive. The phrase passive income is one of the most misused terms in finance. When you live on dividends, you aren't just an investor, you are a full-time risk manager. You cannot simply set it and forget it. Over the last 12 years, I've had to spend hundreds of hours digging through quarterly reports, analyzing payout ratios, and tracking debt to equity levels. Why? Because a dividend is a choice made by a board of directors, not a legal obligation. I remember one specific year where one of my safe core holdings suddenly slashed their dividend by 50% following a bad acquisition. My monthly income didn't just dip, it cratered overnight. To prevent that from happening again, I had to become obsessed with the portfolio. If you aren't willing to treat your portfolio like a part-time job, you are one bad earnings call away from a pay cut you can't afford. This leads directly into brutal truth number 2. Your income is significantly less stable than the spreadsheets suggest. Most people build a dividend calculator, plug in a 4% yield, and assume they'll have a flat, reliable line of income forever. Reality is much messier. Market crashes don't just affect your portfolio's total value, they often trigger a wave of dividend suspensions. During the 2020 pandemic, I watched as world-class companies, businesses I thought were invincible, completely stopped paying their shareholders to preserve cash. When your rent is due on the first of the month and your primary income source decides to pause payments indefinitely, the psychological stress is paralyzing. You start questioning every financial decision you've ever made. What happens when your income drops 30% because of a global event you couldn't control? Most people aren't emotionally or financially prepared for that level of volatility in their steady paycheck. Then there is brutal truth number 3, which is the growth problem. This is the mistake that cost me the most money over the last decade. In the world of dividend investing, there is a massive temptation to chase high-yield stocks, the ones paying 7%, 8%, or even 10%. But there is no such thing as a free lunch. Often, a high yield is a warning sign that the company's stock price has collapsed or that they are paying out more than they can afford. By focusing so heavily on immediate income, I missed out on the explosive growth of the broader market. While my dividend stocks were crawling along, giving me my 4% yield, growth-oriented companies were doubling and tripling in value. When you compare the total return of a high-yield portfolio against a simple S&P 500 index fund over 12 years, the gap is staggering. I realized far too late that by prioritizing the check in the mail, I was sacrificing millions in potential long-term wealth. Beyond the math, there is an emotional side to this that nobody talks about. When your portfolio portfolio is your only source of survival, your relationship with the stock market changes. It's no longer a game of numbers, it's a source of survival. During market downturns, when most investors are told to buy the dip, it's hard to do that when you're worried about whether your dividends will even be paid next month. There's a constant low-level fear of a dividend trap, a company that looks great on paper but is fundamentally rotting. I spent many nights staring at the ceiling, wondering if I had diversified enough or if I was too concentrated in sectors that were falling out of favor. This is where most people quit. The pressure of being your own pension fund is a heavy burden to carry, especially when the headlines are screaming about an impending recession. If I could look back, the biggest mistake I made was yield chasing. I fell into the trap of looking for the highest possible payout without looking at the sustainability of the business model. I bought into several REITs and energy companies purely because their charts showed a high distribution. I ignored the fact that their debt was ballooning and their payout ratios were over 100%. I thought I was being smart by maximizing my income, but I was actually just picking up pennies in front of a steamroller. Eventually, those companies cut their dividends, the stock prices plummeted, and I was left with a permanent loss of capital. I learned the hard way that a 2% dividend that grows every year is worth infinitely more than a 10% dividend that gets cut in half. Starting again now, my strategy would be different. First, I would prioritize dividend growth over high yield. I prefer low payout ratio companies that increase dividends by double digits annually. This guarantees your income matches inflation. Total return is my second priority. To grow my capital, I would own some non-dividend paying growth equities. Third, I would save 2 years of living expenses in a high-yield savings account. This eliminates survival stress in rough markets. Finally, I would automate my reinvestment method longer before living off the cash. Dividend investors benefit most from compounding if they let it work. Even though it was hard, living on dividends for 12 years taught me great financial discipline. Being on a fixed yield helps you minimize lifestyle inflation quickly. Because you know how much capital passive income requires, you're hyper aware of every dollar leaving your account. I gained psychological independence that a wage could not. A world fascinated with get-rich-quick schemes taught me patience. Even in the darkest market days, I knew I had a piece of the global economy if I held high-quality enterprises. That perspective can only be gained by playing for over a decade. Finally, the verdict? Would I repeat it? The answer is yes, but with major modifications. Dividend investment can help you become financially independent, but it's not magic. Constant attention, volatility tolerance, and a profound awareness of growth trade-offs are needed. If you expect a free ride, the market will humble you. If you appreciate it, prioritize quality over yield, and prepare for rainy days, it can provide you life-changing freedom. Dividends can improve your life if you understand the harsh realities before investing. Check out this video to understand how much money you need to live on dividends in today's economy.